So we have the next panel is a panel that goes, I think, to fundamental issues of money design, and is staffed by three people of enormous creativity. So it's my pleasure to introduce Morgan Ricks, is a professor at Vanderbilt Law School and the author of The Money Problem: Rethinking Financial Regulation, published in 2016. Previously, he was a senior policy advisor and financial restructuring expert in the U.S. Treasury, where he focused primarily on financial stability initiatives and capital markets policy. He brought risk arbitrage experience from Citadel Investment Group to his work, and he's generally just been a real force in the discussions about money's design. He's joined, by the way, he's in some ways speaking for his co-authors as well, so I want to mention that John Crawford is here from UC Hastings, and Lev Menand, who has also worked at the Treasury and the Federal Reserve. Jeremy Stein will comment on Morgan's proposal. He's the Moise Safra Professor of Economics and the chairman of the Department of Economics here at Harvard, where he teaches all sorts of courses, and serves on the board of directors of the Harvard Management Company. From May 2012 to May 2014, he was a member of the Board of Governors of the Federal Reserve. We also have James McAndrews, who's an economist specializing in money and banking. He's the CEO and chairman of the board of the Narrow Bank USA, TNB as it's known, USA, a Connecticut chartered bank whose objective is to provide high-yielding safe deposits to institutional investors. I'm going to let him explain that. That's indeed part of the point of this. Previously, he was executive vice president and head of the Research and Statistics Group at the Federal Reserve of New York. And before that, he worked at both the New York Fed and the Philadelphia Fed. So he brings several decades of Fed experience to this proposal and to today's talk. Morgan.
Thank you, Chris, for that introduction. I'm going to try to speak into the mic as best I can, which may involve stooping over a little bit. But it's always a pleasure to be back here at Harvard Law School, and it's a special privilege to be part of this truly remarkable conference. So, as Chris mentioned, this is joint work with John Crawford and Lev Menand, both of whom are here. And this is a paper about central banking, but I think it would be useful to contextualize the paper a bit, and given the themes of the conference, to talk for a moment more broadly by saying something about regular banking of the non-central variety. And let me offer at a general level 4 different ways of approaching the regulation of banking, by which I mean the business model of money augmentation. And I'm talking here about augmenting existing money issued directly by the state. So this business model is familiar. It involves holding a reserve of existing money and then incurring a larger quantity of liabilities redeemable on demand or in the very near term for that existing money. And in principle, this business model can be established using the ordinary background rules of property and contract. I can hear Chris in my head objecting to me right now, but bear with me. So the question for the state is what, if anything, to do about it. And I think there are at least 4 options. One would be no holds barred, anything goes. Under this approach, the government imposes no restrictions and lets the marketplace sort it all out. The other extreme would be public monopoly. Here, the government prohibits the business model altogether, making it off limits for the private sector. So this is exemplified by the old Chicago plan or full reserve banking idea. It was also implied by the Swiss Volgeld initiative from earlier this year that failed. And we'll return to this later in the narrow bank discussion. And then I think there are at least 2 intermediate approaches. One would be licensing. The government establishes criteria of fitness and allows only qualified applicants to engage in this activity, subject to ongoing regulation and supervision. And the 4th I would call outsourcing. And this envisions money creation as a public function. The government here is essentially selecting partners. So think of this more as franchising or procurement. That franchising word is one that Bob and Solly have used, I think, very effectively in their work. And this implies discretionary selection. So the government needs to choose from among these options, and what's at stake in this decision. And I can think of at least 3 things here, and I don't pretend these are terribly original, but just to lay them out. First, instability. runs on private money are a major source of acute macroeconomic disasters. The second will be monetary control, and I think this is fairly self-evident, and we will get into this more when we talk about the narrow bank shortly. And the third one gets talked about the least, but I think it's important. Money creation has fiscal revenue implications. And if we think of this revenue as a public asset, then private sector money augmentation causes a leakage of this revenue, which we can see as a form of rent extraction. And so a number of prominent commentators have written about this over the years. I have a quotation here from my commenter, Jeremy Stein. I hope he doesn't object to this. He and his co-authors wrote a very influential paper a few years ago in which they observed that certain short-term debt instruments offer what they call a convenience yield or money premium, resulting in a pecuniary benefit to the issuer, and they characterize this as a form of seigniorage. So to me, these three considerations cast some doubt on the wisdom of the no-holds-barred approach, and historically, of course, we have not gone laissez-faire. So what have we done historically? Well, we can go back to Genesis, the beginnings of U.S. federal banking law. The National Bank Act of 1863 and 64. Okay, I'm omitting the ill-fated first and second banks of the U.S. here. So the National Bank Act is still the basic core foundation of U.S. banking law, and it very clearly adopted the outsourcing approach. The Act conceives of national banks as franchisees fulfilling a public function, and that function is right there in the preamble, an act to provide a national currency. So this isn't really about regulating private activity. It's not so much regulatory as it is an act of creation. This is small c constitutional, to use one of Chris's phrases. And to make this model work, entry has to be restricted. And so alongside the National Bank Act, Congress famously said, by the way, only national banks, our designated franchisees, can issue money in the form of banknotes. All right, so we started with outsourcing, and over the ensuing century, we shifted in the direction of public monopoly. So the Federal Reserve Act of 1913, among other things, elbowed national banks out of their main business of issuing paper currency. An organ of government now occupied this field. The Banking Act of 1933 established basically that you need a bank charter, as a matter of federal law, that you need a bank charter to incur deposit liabilities, and it wrapped those deposits with a sovereign guarantee. The Banking Act of 1935 established a public convenience and necessity standard for national bank chartering. This is a legal term of art used in the public utility and common carrier space, and it implies discretionary selection. So as late as 1976, the OCC would say the vital relationship of banking to the monetary system precludes complete free market entry with unlimited entry. Okay, and here's a quotation that I think perfectly encapsulates this point of view. The government has a monopoly on the issuance of money, though it has chosen to give up part of its monopoly powers by permitting commercial banks to operate. This is Milton Friedman in 1960. All right, then things changed. In 1980, the OCC announced a shift in emphasis. It would henceforth downplay public convenience and necessity as a factor in its chartering decisions. The marketplace, it said, normally is the best regulator of economic activity. So this was a shift from the outsourcing to the licensing model. You could think of this as from a more public conception to a more private conception of money augmentation. Now, I don't want to overstate the practical importance of this specific shift in policy. To me, its importance has more to do with what it signified. This shift was emblematic of a broader transition from what might be called a money paradigm to an intermediation paradigm as the conceptual underpinning of banking and its regulation. So this was a shift from a more public to a more private conception of the activity of money augmentation. And here's one way of describing how these paradigms differ. The intermediation paradigm sees banks primarily as taking funds that are then lent out, whereas the money paradigm sees banks primarily as issuers of funds. And needless to say, taking and issuing are opposites. Now, you might say both of these things are true. Banks are both particle and wave, and that's fine. But in practice, the intermediation paradigm, without question, became dominant. And as if to underscore this paradigm shift, the OCC in 1987 explicitly embraced what it called a modern concept of banking as funds intermediation. So in part, this was all a component of a broader deregulatory shift, a deregulatory movement of the era. Call it neoliberalism if you want to, and that seems reasonable enough to me. But in banking, there were other forces at work too. For instance, the earlier shift from banknotes to deposits, this gets to the language point of the previous panel, which I find interesting. This shift from banknotes to deposits as the key bank liability was a big source of conceptual problems. I could say a lot about this, but in the interest of time, I'll just say that a lot of commentators over the years have pointed out that banknotes and deposits are virtually identical in economic substance. But while banknotes were plainly issued, deposits always seem to represent something taken and then lent out, thus feeding into the intermediation paradigm. In addition to this, I think the rise of finance as an academic discipline played a big role in the rise of the intermediation paradigm. So Modigliani and Miller in 1958 told us essentially capital structure doesn't matter. And they encouraged us to think of the right side of the balance sheet as just divvying up the economic pie. And so here we have James Tobin. Sorry, I wanted to go back and just highlight McLeod in 1883. It is fundamental error to divide banks into banks of deposit and banks of issue. All banks are banks of issue. I think that's exactly right. Coming back to Tobin. Famous 1963 paper, Commercial Banks as Creators of Money. Note the scare quotes around money here. That really says it all. So he says, he criticizes the mystique of money, and he said, to blur the traditional distinction between commercial banks and other financial intermediaries. Merton Miller, one of the authors of Modigliani Miller, here has a great paper with a legendary, wonderful abstract. Does the theorem apply to banks? And his answer is yes and no, but his real answer is yes, if you read the paper. He says, it's hard to see anything special about bank liabilities. There's Richard Posner, since we're at a law school. Banking has become virtually synonymous with financial intermediation. I use the words bank and banking broadly to encompass all financial intermediaries. Admati and Hellwig here a couple of years ago. The notion that banks produce or create money rests on an abuse of the word money. It's hard to think of a further departure from the money paradigm. By the way, it's not just popular treatments, right? Canonical economic models of banking, I'm going to look at the two economists that are sitting next to me with some trepidation here, and I'll say canonical economic models of banking since 1980. I have in mind here Diamond Divig and Calamir's Khan. See banks as pure intermediaries. Banks in these models are not monetary institutions in any meaningful sense, I would submit. And so this brings me to the last stage of the story, and I'm going to get into central banking for all, which is after the intermediation paradigm really took hold, money in practice became increasingly private. We allowed private monies to proliferate on an unprecedented scale. And in the interest of time, I'm not going to describe this particular figure in detail. The light gray represents what I would call private monies, private money claims. And they exploded exponentially in the pre-crisis years, only to contract very sharply with the crisis. And I can talk more about what I mean by private monies later in the Q&A if people want to. So the important thing to understand for now is that many of these private instruments had no regulatory status as such, which means we've in effect shifted substantially toward a no-holds-barred approach to private sector money augmentation. That's simply a matter of fact. And the results maybe shouldn't have been all that surprising. In particular, we saw financial instability with disastrous macroeconomic consequences. I could also talk about loss of monetary control and seigniorage leakage here, but I think I'll save that for later. So these disastrous results lend support, I think, to the structural approach implicit in the money paradigm, which says that money creation is a sensitive, inherently public activity that should be confined to the government itself and its designated franchisees. In other words, shift back to the right side of the spectrum here, the public money side. And that approach, by the way, necessarily begins with restricting entry. There's a sense in which Tobin was right that suggesting that bank liabilities really aren't all that special. But he failed to see this is the product of a legal and policy choice. The specialness of banks is a choice. By way of analogy, if we repealed anti-counterfeiting laws, the U.S. Bureau of Engraving and Printing would no longer be so special. It wouldn't be so different from private printers, but that's not exactly a blazing insight. Now, if you look at the entry restriction provision in federal law, it says more or less that you need a banking, this is right here, you need a banking charter to incur deposit liabilities, and that's a start. But incredibly, the term deposit is left undefined for purposes of this provision. There's a separate definition in the Federal Deposit Insurance Act, which isn't helpful for these purposes anyway. So you know securities law starts by defining security. Investment company law starts by defining investment company. In these and other areas, there's a statutory definition, a canon of interpretive case law, and a scholarly literature. But in the law of money augmentation, we just skipped the first step, which is the task of defining in functional terms a set of claims that constitute money. This is a flaw deep in the operating system of our financial law. It's just a few lines of faulty code, but instead of repairing this defect, we've added an elaborate hyper-technical superstructure of new code on top of the existing system. So if you want to know whether the intermediation paradigm still dominates, there's your answer. The money paradigm directs us to look here at these few lines of code, but these have been left untouched, and instead we've gone off in 1,000 different directions. All right, this takes me to central banking for all. And I could be efficient about this because it's really very straightforward. Here's the central bank's balance sheet. I mentioned earlier that non-central banks historically have issued paper money and account money. Well, that's what modern central banks do as well. They issue two kinds of money, paper money and account money. The Fed today has about $1.5 trillion of paper money outstanding and about $2 trillion in account balances outstanding. But here's the thing. The two types of money are not on an equal footing in terms of access. Paper money is an open access resource available to the general public, but account money at the Fed is available only to an exclusive clientele, basically banks, the Treasury Department, and a few select other financial institutions, but let's just say banks. And by the way, accounts at the central bank are awesome. They have high interest, so today they're earning 2.20%, right? It's pegged at or very near the top of the Fed funds target range. That's probably more than you're getting on your bank account. They offer instant payments intraday between Fed accounts, so these clear instantly, right? You don't have to wait days or even minutes for your payment to clear. And these are fully government-backed up to an unlimited amount. So the whole concept of deposit insurance is completely superfluous here, right? You can have a $5 billion account balance at the Fed, and it is sovereign money with no need for anything called insurance. So what the paper asks is whether there's an intellectually respectable basis for this dichotomy. Can this special legal privilege of banks be justified and sustained on policy grounds? And our answer is not really, not anymore. And we're, of course, not the first to make the case for public options in banking. Marissa's here somewhere. She's influenced our thinking considerably. Even Tobin himself in the 80s wrote a paper, and there's a couple paragraphs in it that say, wait, maybe we should let everyone just have their account at the Fed. And the central bank digital currency literature that's exploded over the last few years, it sort of at least gestures in this direction. So what the paper does is play this out. Suppose everyone, all U.S. residents and businesses and other institutions had the option to have a bank account at the Fed, call them Fed accounts. Fed accounts would work. Sorry, I said all that stuff, so I'll continue on. Would work the same as regular bank accounts. You'd have a debit card, direct deposit, bill pay features, a web portal for access, monthly statements, and so on. But they would also have all the great features banks currently enjoy on their accounts at the Fed. The high interest, instant payments between Fed accounts, and unlimited sovereign nature of the claim. So for large businesses, that'd be wonderful to be able to have a $1 billion account balance. Right now, a business would never park that at a single bank because of the risk of bank failure and default. So to be clear, this wouldn't be a lending program as we're suggesting. It's that you couldn't go to the Fed and get a mortgage or a credit card. It's just a transaction account. And what would be so great about this? Well, the benefits would be astonishing, spanning an amazing range of areas. So perhaps most obviously financial inclusion. So we have 7% of the U.S. population is unbanked, meaning they don't have a bank account. Another 20% are underbanked, meaning they have a bank account, but they still rely on alternative financial services, very expensive and subpar services, by the way, to meet basic payment and other needs. So Fed accounts could have no fees or minimum balances, which are a big deterrent to bank accounts. And this would be an excellent way, we think, to bring people into the financial mainstream. Payment speed and efficiency. Instant payments would be great. It would be a boon to the business world for payments to clear instantly. Downward pressure on debit card interchange fees, which sort of came up in the discussion yesterday with Sorkin. Debit card issuers, these are regulated now at the federal level in terms of their amount, and I'll get into this in Q&A if we want to. We could substantially reduce a major toll on payments. Financial and macroeconomic stability. So this is something that Jeremy has written about in a different paper. Crowding out of private monies we could do if the Fed, the central bank itself, issued more of its own liabilities to a broader clientele, essentially. And this is one way of doing that. These private monies are a major source, as I put it earlier, of acute macroeconomic disasters. I think the preeminent source of acute macroeconomic disasters in U.S. history, for sure. And we could go a long way toward suppressing them. Monetary policy transmission. So since 2008, the Fed has done monetary policy by writing checks to banks. That's what we do now. We pay interest to banks on their bank accounts, and the hope is that that all passes through to broader money market rates and to deposit rates, and the fact of the matter is it doesn't pass through all that great. So if you allowed a greater clientele for access to central bank liabilities, you wouldn't have to pass interest through the banking system, right? You're passing it directly to businesses and individuals, and you'd have both better efficacy and better distributional consequences of monetary policy. Paying interest to banks that does not pass through is a way of banks extracting rent. And finally, fiscal revenue. So would this be expensive? The answer is, on the contrary, it would generate a lot of fiscal revenue, probably, if there's big uptake, particularly from large accounts. So as I referred to seniorage earlier, the interest the central bank earns on its assets, typically it exceeds by a wide margin its expenses and what it pays on the liability side, and that gets handed over back to Treasury as public revenue. And so the Fed account program, if there was broad take-up and migration, would almost certainly substantially increase government rate. I mean, this is $90 billion a year right now, so the run rate. So we're talking not about peanuts. Okay, what are the key objections? We'll be hearing some of them. Institutional competence. I'm not actually going to say a whole lot about these except the last one, but we go through these in some detail in the paper. Institutional competence might be an issue. Can the Fed really do this? Can a central bank, can an organ of government serve the public in this way? Law enforcement and counterterrorism concerns. This relates to the Bank Secrecy Act and anti-money laundering laws, cybersecurity and fraud prevention issues, privacy and civil liberties issues. All of these are very real, but in our view, they are easily overstated. We address them in the paper. We conclude they're easily exaggerated, and all of these are manageable. None of them will come close to outweighing the huge benefits we described in our view. The last one is effects on lending and financial intermediation, which I will say just a quick word about, and this will be the conclusion of the talk. So imagine the Fed's balance sheet would grow very substantially if there was substantial migration to Fed accounts, particularly by large account holders. And you can imagine a large expansion of the balance sheet, crowding out private money claims. And the question is, what's the effect on lending markets and financial intermediation more broadly? I think we should keep in perspective. U.S. lending markets are $25 trillion, and the bond markets are another $45 trillion. And I haven't even gotten to the equity markets, the public equity markets, another $30 trillion. And that leaves out private. So already up to $100 trillion of financial claims. So the financial sector as a whole is huge. And these assets do not need to be funded by money claim liabilities. In fact, most of them are not funded by money claim liabilities. So if profitable lending opportunities exist, we should expect the market to ferret them out, even without money claim funding. But it's also worth adding the Fed might choose to replace banks' lost deposits and other money claim funding with discount window lending, at least in the first instance. This would not increase risk to the government, in our view, since the federal government is effectively backing all these liabilities anyway, whether explicitly or implicitly. So if the Fed chose to do this, in principle, you shouldn't expect any changes to lending markets, and you could start to look at the banking system as portfolio management outsourcing for the central bank. All right, I'll make one last point, which is sort of historical and philosophical. banking history, and I referred earlier to banking history, private banks used to issue basically all the paper money in circulation. Then we created the Fed in 1913. It soon displaced private banks in this. Most of us think that was a pretty good thing. This is a natural role for government. Money's a public good in at least some kind of broad sense. And it will be sort of silly to think that that was the end of history for government's role in supplying money to the public. This is a digital age. Most payments now happen digitally. The Fed offers paper money, so why not also digital money? That's what a bank account is. It's digital money. So this will be providing key infrastructure directly to the public without being mediated by private providers. And we see this as on par with the Interstate Highway System or the Post Office Act of 1792, except this would be way easier than those things. Okay, I'll stop there.
That's not good. Sorry about this. Let's see. That work? Great. Okay. First, Chris, thanks very much for inviting me and for putting me on this very, very interesting panel. Look, this is a really interesting piece of work. And like, if you've read some of Morgan's earlier writings, or like me, you've had conversations with him, you know that the great virtue, it sort of really forces you, like this in particular, forces you to go back to first principles and really kind of challenges your assumptions. So it's just terrific in that way. So let me just try to be clear. There's a lot in the paper, and I'm going to kind of boil it down a little bit. You know, you could ask what exactly is the problem that Morgan and his co-authors are trying to solve. There's at least two. Maybe there's a little bit more. One is, you know, private banks seem to treat their depositors, and in particular their retail depositors, pretty shabbily. Right? Think about the deal they have. The government says, oh, you can offer FDIC insured, in others, you have the franchise, as he puts it. You can offer government insured deposits. What do? They basically offer those deposits and pay zero, even when interest rates in the market are like 3% or 4%, right? They charge a lot of, you know, fees and stuff. They make it hard for people who have small accounts to basically find it economic. They do all kinds of nasty stuff with the overdraft fees and, you know, and the way they order them. So, you know, you might say they're kind of abusing this franchise a little bit. And so one idea is, well, let's have the Fed essentially take over this deposit-taking function, which is a very, very important part of banking. So that's one thing. The second, very logically distinct, is, you know, banks and financial intermediaries in general have kind of gotten themselves involved in a lot of financial crises, in large part, why? Because they issue these money-like claims. Money-like claims here being just very short-term, you know, apparently safe claims. Now, of course, the ones that are insured are safe, but banks issue a lot of uninsured deposits, and the shadow banking system issues a lot of things that look like they're money good in good times, turn out not to be, and as a result, you get runs. Well, an aggressive form of this, of the Ricks et al. Proposal would basically have the central bank provide all forms of what had heretofore been private money, not only bank deposits, but essentially take market share away from money market funds and the like. Now, of course, once you get rid of all that, then you don't have the private sector issuing the stuff anymore, and presumably you've mitigated the risk of financial crisis. So those are the two problems. Let me start by just being a little clear. So this is before we have a view on whether this is good or bad. We have to just sort of be clear on what the constraints of the problem are that we're operating under. Okay, so you know, Morgan mentioned that the Fed balance sheet could get kind of big under some of these. I just want to give you sort of a sense of like what big is here. So there's three items in principle. One is sort of think of it as the market rate of interest. It doesn't much matter if you want to call that the T-bill rate or the Fed funds rate. It's sort of the market rate of interest. Then there is what's sometimes called IOR. That's the interest that the Fed pays on, right now, just to the banks, but presumably under Morgan's thing, would be to anybody who deposits at the Fed. And then there is the size of the Fed's balance sheet. Okay, now here's something I think we can all agree on. You can only pick two out of these three. Okay? So in other words, the macroeconomists at the Fed are going to pick the market rate. They're going to say, well, the market rate has to now be 3%, otherwise we're going to have unemployment or some bad thing. So now you're down to picking the other two. Okay? So for example, let's say, then the third has to be whatever it wants to be for the market to be in equilibrium. So for example, if the Fed wants to take all comers as depositors, that is to say, not just banks, but anybody who wants to deposit, and it wants to pay them a generous rate, that is to say, it wants to pay them a full market rate so that the interest on reserves is approximately equal to the market rate, well, it's going to do a lot of business, right? So then it's going to have to accept that a lot of people are going to come, and it's going to have a very, very large balance sheet. Okay? Now, alternatively, the Fed could say, well, I don't want to have a large balance sheet. I'm willing to do it up to, say, my balance sheet being $5 trillion. Well, if it's still going to take all comers, then it's going to have to pay those comers a lower rate, right? It's going to have to basically set the rate low enough so that not that many people want to come. So then you have to set IOR to whatever the market tells you it has to be in order to cap your balance sheet. Okay, so those are just the constraints of the problem. So with that, let me sort of sketch sort of two different flavors of Morgan's thing, a sort of a small flavor and a really, really big flavor. So here is the small flavor. This is kind of trying to solve problem one, but not necessarily solve problem two. So for example, say the market rate, the macroeconomists have told you the market rate has to be 3%. You don't want to blow up your balance sheet too big. You just want to kind of take those retail depositors who'd been getting screwed by their banks and getting zero and give them a somewhat better but not full market deal. Okay, so you say, I'm going to pay these guys, let's say 2%. Okay, now let's just pretend, for the sake of the example, that everybody who was getting zero from their commercial bank says, oh, that's a great deal, I'll come to the Fed and I'll deposit it too. Now, one thing I should say, if you want to get my parents, and I suspect many of your parents, to do this at the Fed at 2%, it's not going to be enough just to offer 2%. You're going to have to offer a branch network and a nice teller and all that kind of stuff, because so my dad can kind of go and deposit his check and do all that kind of thing. So they're going to have to actually be a bit more in the retail business. I mean, because after all, how is it that the banks managed to screw my parents on the zero rate? It's because they offer them a bunch of other stuff that they like, maybe that they overvalue, but that they basically like. Because after all, my parents do have the option to get a full market rate now by putting all their money in a money market account, but they sort of like the branches and all that. So it's not trivially obvious that you get all this stuff, but let's just sort of assume. Okay? So what would happen? Roughly speaking, total bank deposits about 12 trillion. I'm completely inventing the idea that about 80% of these are retail deposits, so call that 10 trillion. Okay? So imagine that the Fed gets in 10 trillion of deposits. Okay? Now, the banks have lost those deposits, so how will things shake out? And let's imagine that the world doesn't have 10 trillion of Treasury securities. It's just cleaner this way. Okay? So now the banks are short 10 trillion. So what does the Fed do? The Fed's balance sheet will basically have 10 trillion more of deposits, and essentially the Fed will now lend 10 trillion back to the banks. So the banks, instead of borrowing directly from the public, are borrowing from the Fed. The Fed is acting in its role as a lender to the banks. Okay? Now you might say, I'm a little uncomfortable with the Fed having a $10 trillion balance sheet and using it to lend to the banks. Now here, Morgan and his co-authors are exactly right, that if all we've done is disintermediated insured deposits, the government was standing behind those anyway. Okay? So now, instead of the FDIC backing them, the Fed will be lending to the banks, but the Fed is not taking any more risk to the banking sector than they were before. We're just doing it differently. We've essentially cut out the bank's rents that they earn in the deposit-taking business, but we have not underwritten any more bank risk. Okay? So that, I think it's a very well-posed problem. We've got this problem essentially of the banks absorbing too much in the way of rents, and this is a solution. I think the right question, it's sort of a mechanism design question, is to take the statement of the problem as given. We accept that this is a problem we'd like to solve, and then say, is this the single best way to solve it? The obvious alternative is essentially to continue to outsource, to have like a heavily regulated monopoly. So you might say, well, why is it not better to then, you say, you can't have these kind of account minimums, you can't have these kind of fees, there are minimum rates relative to market rates and all of that. And then, of course, the advantages are you might preserve some of the good things that the private sector does, like, you know, some banks will have like pretty cool websites that people can go to and nice branches and all. I mean, after all, you may not think that they're delivering the full 3% worth of services, but they are delivering services that people plainly value. And, you know, they compete, and so that competition presumably is of some value. So I think the really important question here, I don't think you can just say the Fed does this and we assume away branches and websites and all that. That is the essence of retail banking. So you have to ask the question, does an alternative design give you a little bit better performance on that while still maybe solving some of the problems? So I leave that as a question, but I think that's the sort of the question you need to ask. Second, here is the more ambitious version of the proposal, which is, you know, this is the stuff that speaks to financial crises. The crises very manifestly don't come from insured retail deposits. Those are the ones that don't run. It's either the bank's wholesale funding or essentially shadow bank money. You can think of this as asset-backed commercial paper, repo, money fund stuff. So here's the aggressive version. The Fed says, look, we're going to pay a full market rate. Okay, whatever the macroeconomists have decided, 3%, we're going to target a regime where the Fed's deposit rate is roughly the same. And in so doing, we hope to attract essentially not just retail depositors, but even people who are, you know, the big, non-financial firms that were depositing at Citi will say, hey, I was getting a decent interest rate from them, but I'll get just as good an interest rate from the Fed, and we won't need commercial paper and all that stuff. That's going to be a big, Morgan showed you the graph. I mean, the deposits were only a fraction. So this is going to be a very big balance sheet. Okay, I'm just making up a number and calling it 20 trillion. Okay, probably even bigger, but 20 trillion would basically take over the whole private market short-term financing and put it inside the Fed. Now, again, they got a little bit of a problem, which is they need to fill up the asset side of their balance sheet. They just raised 20 trillion of financing. They got to invest it in something. And even in your sort of wildest dreams of government infrastructure spending, there ain't 20 trillion of government bonds yet outstanding. They've basically got to then take this 20 trillion and lend it back to the financial sector. Okay, now here's where Morgan's argument, I think, is a little less clear. Now they're replacing not only previously insured deposits, but a lot of stuff that wasn't insured. In other words, the banking system, you know, is raising some insured stuff, but it's taking some uninsured stuff. People are putting their money at risk. Large depositors, institutions are putting their money at risk when they lend to the banking sector, to the non-banking sector. Now the Fed would be eating all that credit risk. So that's a big intervention. That's a big intervention in the markets. Now, here's, I think, where we disagree a little bit. Morgan might say, look, in the financial crisis, the government ended up backstopping all this stuff, so de facto, the government is the insurer. You know, that was true in the financial crisis. Stuff isn't priced like that. In other words, if you look at the pricing of, you know, commercial paper or whatever, it is risk sensitive because people don't expect, they don't count on the government stepping in all scenarios, okay? So there is some discrimination, and that presumably has some allocative effect, and that presumably has some moral hazard tamping effect. Of course, that's not to say that there doesn't remain a moral hazard associated with the likelihood or the possibility that they'll step in, but this is a bigger step. This is clearly a bigger step of just saying, basically, we're going to just finance the entire financial sector. You know, and then how do you decide which banks and when they've kind of run up against their credit? You know, so that's a big thing. And I think, you know, there are other ways to go. The sort of first order other way to go is with financial regulation. Now, you know, you can argue obviously, and I'll be your first to agree that it's highly imperfect, but that's a way to go to sort of essentially try to rein in the tendency of the financial sector to finance itself with short-term claims. Even if somehow Morgan got me on board, and I'd be hard to get on board with this, the idea of sort of blanket insuring all claims issued by the financial system, somebody talked about sort of this central bank and the legitimacy of the central bank and what should be kind of delegated. I wouldn't, you know, in my wildest, most power-hungry, you know, fantasies of being a central banker, I wouldn't want this job. right? I mean, this would, if I had any hope to be able to be independent on more mundane matters of monetary policy, the idea that I get to sort of ensure the entire financial system is a pretty scary one. That's something I'd want to have that's an absolutely fiscal set of issues, and I'd want to have that a little bit more located in, I don't know if it's in the FDIC or something, but some other agency that's not necessarily the central bank. Now, having said all of that, I'm absolutely on board with sort of the underlying premise, which is, look, we've got this sort of very serious financial stability problem, which is created by the fact that, as Morgan says, that the primary function of banks is not just lending, it is creating these safe money-like claims. Private incentives to do that are awful strong because it's cheap financing, right? There's a bunch of people who will take a low interest rate if you give them this very safe claim. So the private sector tends to overdo it relative to what a sort of sensible social planner would have them do, so you get too much of this money creation. Okay, now this is what Dan and I spend a lot of time trying to think about as a regulatory matter. And again, I think the regulation is well-intentioned and is likely helpful. It's almost certainly not strong enough to sort of deal with these very, very strong private sector incentives, right? So you regulate the banking system, but it's going to want to pop up elsewhere because it's just so cheap to fund yourself with short-term stuff. So there's this idea, and Morgan referred to it, which is, it would be a good thing if the government supplied more short-term safe stuff. So the private sector would have less incentive, so market rates would adjust, and the private sector would have less of the job to do. So I agree with that. Here's a more modest version of that. Treasury could do this, by the way. Treasury should issue more 30-day bills and less long-term bonds. That will satisfy the appetite, essentially, of the private sector, satisfy the appetite of investors to have this stuff. Because, of course, if the Treasury doesn't make a lot of T-bills, you're going to have a lot of guys in the private sector going, this paper is just as good as a T-bill, kind of almost, except, on Lehman days, right? But it's basically, asset-backed commercial paper and repo and things like that were essentially sold as near T-bills. If there were more T-bills, you'd have less incentive to market that. So that's, I think, a good idea. That can be done by the Treasury. Alternatively, it can be done by the Fed. So this is just the Treasury adjusting their maturity distribution. They could do that, or the Fed could essentially do it for them by buying the long-term Treasury bonds and issuing short-term paper to, now in this case, I'm sort of, I think, more in Jamie's boat. I wouldn't issue this to, the whole retail thing is like a way different, more complicated business. But I do think it's odd that the Fed circumscribes the issuing that they do just to banks. And so for a while it was a problem, and we had this thing called the reverse repo facility, where we were trying to basically also bring in money funds, but bring them in at a punitively lower rate. So basically the Fed was paying 25 basis points more to banks than to why you would do that, I don't know. So a simple form of democratizing that cuts out some of the banks' rents is to pay the same essentially to banks and to money market funds. The money market funds being essentially a wrapper that then allow it to be passed through to the households. So I would certainly be sympathetic. I thought it was a very good idea to make more use of this reverse repo facility. So if you gave me kind of control of the thing, I would basically keep the Fed balance sheet at roughly its maximum size. I would democratize in the simple sense of not having a differential rate for banks and for non-bank institutions like money market funds. I wouldn't get into the retail business. And I think this would at least go a little way. And I think, by the way, Jamie's narrow bank is essentially a very close cousin of this. And I think this goes some partial way towards helping the financial stability problem. Obviously, it's meant not to do the whole job. It's meant to be in complementarity with the regulation. And in that sense, I agree. Okay.
Great. Well, thanks very much. I'm James McAndrews, and I'm really happy to be at this conference. I want to thank Christine Deston and Jeremy for inviting me to speak today. And I'm here to talk about narrow banking. Much of the ground has been covered, but I'll rearrange all the words that Jeremy and Morgan said in their sessions. What is a narrow bank? A narrow bank is a depository institution that invests the proceeds of the deposits in safe assets. Now, in the case of TNB, the bank that I've founded with colleagues, all the proceeds will be invested in reserves in an account at the Federal Reserve Bank of New York. The Federal Reserve Bank of New York is our administrative reserve bank by virtue of our location in South Norwalk, Connecticut. And the purpose of TNB is to attack an issue that was mentioned by both Morgan and Jeremy, which is that deposit markets, both retail and wholesale deposit markets, are not perfectly competitive. Retail deposits have deposit insurance, as both speakers have pointed out, and provide stable funding to banks. Larger depositors, though, are very rate sensitive and flighty. The interaction between them and the private sector suppliers of this short-term runnable securities is a major financial stability risk. So narrow banks offer a vital way to improve competition and address this financial stability problem. So they can kill two birds with one stone. By the way, this approach to narrow banking and the project of TNB and so on has almost nothing to do with the Chicago Plan narrow banking or Volgeld enterprises or anything like that. The purpose is to provide higher deposit rates than are currently available in the market to institutional investors in a safe way. It's perfectly complementary with our banking system. Now, in my remaining slides, I have a lot of words on the screen, and I don't want you to read the words. I'll select a few words. They're more notes to myself, so I apologize for that. But the first thing we should do is have a little bit of a primer on interest on reserves. It's a very confusing time because interest on reserves came coincident with the financial crisis, and yet they really had no logical connection with the financial crisis. Interest on reserves were authorized by Congress in 2006, well before the financial crisis, in the Financial Services Regulatory Relief Act. Now, various governors of the Board of Governors testified between 1999 and 2006 in favor of interest on reserves. Governors Olson, Meyer, and Ferguson. Governor Meyer, for example, said the board strongly supports proposals to allow payment of interest on demand deposits and on the required and excess reserve balances that depository institutions maintain at Federal Reserve banks. These legislative proposals are important for economic efficiency. Unnecessary restrictions on the payment of interest on reserve balances distort market prices and lead to economically wasteful efforts to circumvent them. This is a very important principle. Prior to the ability to pay interest on reserves, which again was essentially the first 100 years of the Federal Reserve Act, they could not pay interest on reserves, but they required banks to have reserves. This was essentially a tax on banks called the reserve tax. And you might not think it's a bad thing to tax banks, but the bad thing was that banks took all sorts of wasteful efforts to economize on reserves, the very thing that is needed to pay depositors when there are heavy withdrawals. So it went completely counter to the efforts that Jeremy was talking about that he conducted with Dan Tarullo to encourage banks to hold more liquid assets. So paying interest on reserves is a fundamentally important efficiency improvement in our financial system. In addition, the governors were also lobbying for the payment of interest on by banks to commercial depositors. This was the last vestige of Regulation Q, which still existed and was only overturned finally in the Dodd-Frank Act. But in discussing how interest on reserves would work with banks' payment of interest to depositors, they said the higher cost to banks of paying interest to these commercial depositors will be partially offset by the interest on reserve balances. So the governors foresaw a pass-through of the interest that banks receive from the federal government through the Federal Reserve banks to the depositors. This was always part of the plan to have this pass-through competition in place. However, as Jeremy and Morgan stated, but perhaps it's good to see a graphical depiction of this, banks do not pay interest on to depositors. The top line is the rate of interest that banks receive from Federal Reserve banks, the interest on reserves rate. The bottom three line are what large depositors earn at banks. That line that has this slight upward slope is a 6-month jumbo CD rate. So you give your bank more than $100,000 for at least 6 months, and that's the rate you'll get. The bottom two lines are respectively the jumbo CD rate, the jumbo savings account rate and the jumbo checking account rate. This is an arithmetical average across all the banks in the United States, published by the Federal Deposit Insurance Corporation. Depositors have earned a miserly return for 10 years. Now, it was one thing when the rate of interest was at the essential lower bound, but again, since 2015, the Federal Reserve has been raising the interest rate. As Morgan pointed out, this rate that banks earn at the Federal Reserve now is 2.2%, and banks are still paying roughly 10 basis points. But it's not just retail depositors. There's a lot of evidence that retail depositors have these they're sticky, they have costs of switching banks. So they have a hard time moving from one bank to another, and there's a tremendously large economic literature on that. But it's not just retail depositors. Wholesale depositors also, do not face perfect competition when approaching their banks. And these are depositors who can deposit tens of millions of dollars, hundreds of millions of dollars in banks. So what we see here is a diagram that goes from 2009, after the crisis had passed, up to 2013, before this reverse repurchase facility was put in place, as Jeremy was describing, in 2014. And what we see is, in the top line, is the rate of interest that banks were paying, the rate of interest on reserves, 25 basis points. And the bottom line is the federal funds rate, which is essentially the overnight rate that a very large depositor, in this case the federal home loan banks, who would have millions of dollars to place in the bank, that's the rate they would get from the banks. It went down to 6 basis points, jumped up. This is not a perfectly competitive market. And so this is, at the same time, the primary method that the Federal Reserve was going to use to raise interest rates was by adjusting the rate of interest on reserves. There was some of those excess words on a previous diagram. So the Fed faced a true dilemma. They wanted to raise interest rates. In 2012, 2013, they could foresee that the economy was growing, the unemployment rate was falling. At some point, they were going to have to raise interest rates. How were they going to do it? By raising that top red line, there was no assurance that the blue line would follow, based on this experience. So what did the Fed do? They did, from their perspective, a very sensible thing. They created a narrow bank. They went into competition with banks and created a narrow bank. Now, they call this narrow bank the Overnight Reverse Repurchase Agreement Facility. Very complicated name. What in the world does that mean? Well, practically what it means is that 160 firms, primarily money market mutual funds and these federal home loan banks, can go to the Federal Reserve any day, place funds at the Federal Reserve with perfect security and get an interest rate for it and take the money out the next day. Just exactly how a narrow bank works. Now, Simon Potter, who's the SOMA manager, the System Open Account Manager at the Federal Reserve Bank of New York, said, when we were at the zero lower bound, we weren't able to rule out the possibility that initial increases in the policy target might not translate one for one into increases in money market rates. The ONRP, which is offered to a broad selection of counterparties, that includes money market funds, is intended to intensify competition in money markets. So the Fed had exactly the same incentive that TNB has. They wanted to inject competition into money markets. They went into business against the banks. They went into competition with the banks. Simon Potter also pointed out that as a long-standing service to foreign central banks, foreign governments, and international official institutions, the New York Fed runs an overnight investment facility known as the Foreign Repo Pool. Use of the pool has grown to about $247 billion in February 2016. So the Fed has two narrow banks, one for foreign central banks and one for these 160 money market mutual funds and Federal Home Loan Bank. They pay different interest rates, and they're a different interest rate from the rate that they pay banks. So the Fed has this complex system, but they have found that this narrow bank is highly useful because it provides a true floor on money market interest rates. This picture, by the way, is from Harry Brown, an undergraduate thesis from Yale University this year. And Simon Potter said, "We have now seen in practice that changes in administered rates can effectively move market rates, both because effective competition helps bring administered and market rates closer together, and because the mere existence of administered rate facilities like the RRP I mentioned earlier can affect competition." So what the Federal Reserve officials are pointing out is that if people have the option of going to the public facility, then they can negotiate with their private borrowers. Say, I can get this much from the Fed, why don't you give me more than that? Otherwise, I'll just go to the Fed. And sure enough, this bottom green line is the rate of interest on the overnight reverse repurchase facility, and the blue line is the first percentile of federal funds rates in the market, and you can see it provided a very strong floor, unlike that picture of the interest on reserves, which provided a very poor magnet to interest rates. So this is a very powerful realization. We've been living in this narrow bank world now for 4 years, and it's worked well in terms of getting interest rates above the rate on the narrow bank. This has led many commentators to say we should expand this facility. Joe Gagnon of the Peterson Institute and Brian Sack, who was the previous SOMA manager, suggested that the overnight reverse repurchase agreement facility of the Fed's narrow bank should be greatly expanded because it has all of these benefits. I won't go through them all, but among them are it enhances the integration of financial markets, it saves taxpayers money, and so on. But there's another side to all of this as well, which is that narrow banking provides a crucial financial stability tool. It's a shock absorber. Here's an interesting case study presented by Simon Potter. In October 2016, the money market mutual fund regulations were changed, and Potter reports that the entry into force of these new SEC rules could make prime funds less attractive. Substantial amounts were expected to come out of prime funds and into government funds. The size of the reallocation ended up being quite a bit larger than most had expected. About $1 trillion of assets migrated from prime to government funds by late 2016. The good news is that the ONRRP facility served as a shock absorber for overnight rates. Government funds increased their use of ONRP during the transition. Because of the availability of the ONRP, government funds knew that they would be able to temporarily place some of their new funding they received at the facility. As a result of this elastic provision of a risk-free investment opportunity, overnight secured and unsecured rates were only modestly affected by these large flows. This elastic provision, Morgan was talking about the preamble of a different act, the preamble of the Federal Reserve Act points out for the provision of an elastic currency, and the Fed was doing this here with the creation of this narrow bank. And that points out how narrow banks can improve financial stability. As mentioned earlier, the article that Jeremy wrote with Robin Greenwood and Sam Hansen in 2016 followed up on an important article they wrote in 2015. And they pointed out, based on the empirical results, that the key threat to financial stability is the tendency for private sector financial intermediaries to engage in excessive amounts of maturity transformation. That is, to finance risky assets using dangerously large volumes of runnable short-term liabilities. There is a whole host of these runnable liabilities leading up to the crisis. VRDOs, ABS, commercial paper, asset-backed commercial paper, medium-term notes, CDOs, CDO squared, VRDOs, ARS. It was just enormous numbers of these different runnable liabilities. When the crisis came, you see in the red line there, it's the net amount of these shadow banking liabilities. it exceeded the amount of bank liabilities, and then it crashed once the crisis came. And these are extremely risky. This led Jeremy Stein to recommend that expanding the supply of safe short-term claims through the overnight reverse repurchase agreement facility, the Fed can weaken the market-based incentives for private sector intermediaries to issue too many of their own short-term liabilities. So, and Jeremy reviewed that in his remarks. The problem of the solution that Jeremy was just suggesting at the end of his remarks, that the Fed do this and set the rates of interest equal, similar to Joe Gagnon and Brian Sack's suggestion, is that the Fed is not intended to compete with banks. The Federal Reserve Act was structured so that the Federal Reserve is a bank for banks. Now, we can say, oh, well, let's, in the future, rewrite the Federal Reserve Act and so on. I'm kind of the, the practical person here at this conference, and we have a Federal Reserve Act. Let's use the Federal Reserve Act we have. And there are many statements by the Fed that said participants in which they say the overnight reverse repurchase agreement facility, this narrow bank, was absolutely necessary for the implementation of monetary policy, but it couldn't be any bigger than it must be. Participants generally agreed, I'm reading from the bottom quote, that the overnight reverse repurchase agreement facility should only be as large as needed for effective monetary policy implementation and should be phased out when it is no longer needed for that purpose. Participants expressed their desire to include features in the facility's design that would limit the Federal Reserve's role in financial intermediation. I guess the Fed had never competed with banks throughout its history in such a direct way. They come in competition with banks, and they don't want to pay the same interest rates to non-banks, to bank customers, erstwhile bank customers, that they do to banks. So they're a reluctant intermediary in this sense. And I think that's understandable. The alternative, then, is a private sector narrow bank. Private sector narrow banks can accomplish these objectives of both increased competition for the pass-through of this interest on reserves, integration of money markets, taxpayer savings, and other benefits as suggested by Gagnon and Sack, while at the same time providing a systemically safe deposit facility for flighty wholesale depositors, as suggested by Jeremy Stein and his co-authors. Now, what are the drawbacks? And we heard some of this previewed in the previous comments. Would narrow banks shrink the supply of private credit? No. Let me just point out, we've been living in the narrow bank world for 4 years. As Simon Potter says, we have now seen in practice, lending volumes in secured and unsecured money market funds have been stable, suggesting that the Federal Reserve's facilities have not displaced activity in the private sector. This is an amazing fact. The Federal Reserve does $700 billion in facilities, in narrow bank facilities, and the SOMA manager is saying it's had no trace in the quantities in secured or unsecured money markets. We've seen that in the retail bank sector, it's had no effect on the deposit rates. You would think after 4 years, Jeremy's mother and father could have moved over to a money market mutual fund. But no, even in the long run, there's had no effect on retail bank competition. I thought Jeremy was a bit alarmist when he was reviewing some of the potential size effects of Morgan's proposed policy. Because the first effect we would see, if we would see effect, would be an increase in price, an increase in rates by the competitive sector, by the retail banks or by the wholesale banks. And that's what we can infer from Potter's comments, that the Federal Reserve came in, it set a bid in the market, and other people raised their bid. It didn't necessarily affect market volume so much. So I don't believe, even in the wholesale market, that the Federal Reserve would necessarily attract huge quantities. Instead, what would change is that the rates of interest paid by those private sector competitors to the narrow bank would be raised. And I have a paper that suggests this effect from 2017. Another concern is that, well, the narrow bank would propose a new risk of run that people would run into the narrow bank. First of all, where do people run into now? Well, they run into government, money market, mutual funds, and too big to fail banks. A narrow bank wouldn't upset that. There would still be government-only money market funds and too big to fail banks, and people would still run into those things. Narrow banks would have nothing to do with it. Furthermore, narrow banks add little capacity relative to these existing alternatives under stress, because it takes days to acquire a new deposit customer. You have to learn who the customer is, sign a deposit agreement, and so on. There's not going to be any overnight run into a narrow bank. And existing depositors can be throttled if that would benefit stability. But again, we've been living in the narrow bank world for years. How does the Fed's narrow bank facilities handle these risks? Again, from Potter, he said, we address the risk of sudden surges in take-up in a couple of ways. For example, we can employ vigilant market monitoring to detect any such shifts and allow the FOMC to formulate a response. We also use per counterparty caps and can use an aggregate cap. So these are the same sort of techniques that a private sector narrow bank could employ as well. A private sector narrow bank also has reputation concerns for not aggravating distress in any way. But it's important to recognize that if this is a concern, if we're concerned about run, then flighty depositors should be offered safe deposit facilities in the first place. This is slightly different from Jeremy's point of crowding out of other private sector borrowers who are creating these things. If there's a run risk, then the first thing that we should do is offer safe deposit facilities for these flighty depositors. Well, I never thought I'd hear mechanism design in this conference, certainly not before I spoke, but Jeremy raised the issue of mechanism design. But if we're thinking about a mechanism design approach, the design of the monetary system in the United States, as has been pointed out in this conference many, many times, relies on banks as distributors of money. And since the 1930s, banks can offer safe deposits accounts through the issuance of FDIC-insured deposits. This is a very important fundamental design of the U.S. banking system. Now, if a social planner intends to provide a safe depository for flighty wholesale depositors and to improve competition in the market for large deposits, then I would suggest that the solution to that problem would be design a private sector narrow bank. Such a design avoids a moral hazard associated with deposit insurance guarantees, so I don't think deposit insurance for large depositors would be chosen by the social planner. This is a point made very forcefully by James Tobin. It avoids the administered rates of the Fed's narrow banks, the lack of harmonization across those rates, and the obvious conflict of interest that the Fed itself feels in offering deposit facilities to erstwhile bank customers. And it puts the private incentives of narrow bankers to work to solve these safety and competition problems directly. And reducing this conflict of interest with the Fed's own narrow bank facilities is an important goal, I would suggest. So in summing up, TNB USA was designed to pay higher than currently available interest rates on the safe deposits of institutional investors. It would improve competition in the deposit market and in other money markets. It would strengthen the transmission of monetary policy and improve financial stability. Now, I would also say, the time has come to allow this formation of these private sector narrow banks, not just public sector narrow banks. And that is indeed allowed and required under federal and state law. I would just say one thing. Many people react to the narrow bank and say, oh, this is a pass-through to the Fed, or this is the Fed account. It is no more of a pass-through to the Fed than any other deposit account at any other bank in the United States. Every bank in the United States, every depository institution in the United States has access to a Federal Reserve account and access to this interest on reserves. TNB would be no different than any other bank in that regard. It would simply not engage in the other activities that banks typically do. And so I think that, and the other thing is when a person gets a deposit in TNB, they're getting a deposit in TNB. They're not getting a deposit at the Fed. The legal contract they receive is a deposit at TNB. But with that, I'll finish up, and again, encourage the Federal Reserve to issue an account to T&B. Thank you very much.
Well, I'm slated to comment on Jamie's paper. I'm going to be very brief because I want to make sure we leave time for questions. I just have a couple of points to make here. And first, maybe not everyone's aware of this, and Jamie can't really talk about it. He's engaged in a lawsuit with the New York Fed. He sued the New York Fed to ask them to allow him to have a master account there. They've declined to give it to him. He does have a duly authorized charter from the state of Connecticut, and he argues that this entitles him under the Monetary Control Act of 1980 to a master account, and there is going to be a very interesting debate. The Fed, New York Fed, has filed its not an full answer yet, but a letter preceding its motion to dismiss, and we're going to see this unfold over the coming months and maybe year or so. The Fed has cited policy concerns here, to one of which is control over interest rates, and the other of which is financial stability. On the financial stability side, I tend to agree with Jamie that it's sort of an indictment of the idea that creating giving more access to sovereign money would actually exacerbate financial instability because there will be more runs during a crisis is sort of just an indictment of our entire privatized money system. So he didn't put it quite that vehemently, but I'm agreeing with him there. Quick points. The creation of the reverse repo facility, the Fed always said this was about the Fed funds rate. The Fed announced that this was about the Fed. It can't possibly be really about the Fed funds rate because the Fed, if it were just about the Fed funds rate, they just would have offered it to the GSEs. The only reason the Fed funds rate was falling below the interest on reserves rate is because the GSEs weren't receiving interest on reserves. So that would have been the way to do it. What they wanted was broader money market rates to rise, and this was a reflection of the lack of pass-through we're getting to broader rates, certainly to retail deposit rates, but even to broader money, even to Treasury repo rates, right, which is really what was the floor that the reverse repo facility sets. This notion of reserve tax, I'm going to disagree with Jamie. We argued about this some time ago, 2 weeks ago. I think this notion of a reserve tax is really, everyone says there's a reserve, the fact we don't pay interest on reserves is a tax on banks, yada, yada. I mean, this goes back to Milton Friedman and others. Banks have it's just a package deal. They have a set of extraordinary privileges, and then there are some regulatory costs and other costs, and we need to think of that. And to single one aspect of the contract as a tax is sort of stacking the deck. Jamie may think it's sort of an inefficient way of doing things, but I'm going to talk about this, a little differently. The Fed has decided to get rid of the reserve tax. It's now paying the same rate. This is an extraordinary thing. Interest on required reserves and interest on excess reserves rate is the same. The Fed says they serve two completely different purposes. One is offsetting a purported tax on banks. That's their interest on required reserves. Interest on excess reserves is a tool of monetary policy. Isn't it just sort of bizarre that they're always set at exactly the same level if they're two completely different things? And of course, the reasoning is perfectly circular. What the Fed is saying is, this is the opportunity cost of having reserves, that you don't get to earn the interest on excess reserves rate because we have put a reserve requirement on you. But it's just a perfect conceptual circle that we put ourselves in here. Fed is not interested in competing with banks. I mean, I'm going to disagree with this a little bit also. As I mentioned earlier, the Fed elbowed national banks out of their main business of issuing paper currency. That's what the national banks were created to do. We created a Fed, and it competed. Not only to compete, he just drove them completely out of their business. So this public-private divide is not static, and it hasn't been static since the very beginning. Finally, I'll just say, I think one question this raises, and we don't talk about this enough, is whether interest on reserves is a good way of doing monetary policy versus the old way. Writing checks to banks is a way of doing it versus putting the squeeze on banks. And those are two very different approaches in terms of their distributional consequences. We can say it's not. We can pretend everything's supposed to be arbitraged away, and these are essentially the same thing. In practice, I do not think they are the same thing. And this has not been, it's not sufficiently transparent for this to be a topic of public debate. But I have real questions about how the public interest is represented in our shift in the approach to monetary policy. And I would respond to some of Jamie's comments, but maybe we should just do Q&A and then things will come up. Are you keeping the queue, or?
Morgan, thank you very much. You put a slide up that showed as far as basically the money supply and growing and the difference between private versus public money supply, if I understand it correctly. Is that private money supply really just a guesstimate? And then really how should we actually calculate money supply? Because you talk about Eurodollars and stuff like that. And how is that, do you foresee that, if that's just really a guesstimate, that's not some type of unknown risk or unquantifiable risk?
Well, the only line up there that was a guesstimate is the Eurodollar line, right? We don't have a good estimate of Eurodollars being dollar-denominated short-term debt of non-U.S. financial institutions, and it is an enormous market. It's actually probably almost certainly larger than every other private line. It's probably on the order, certainly pre-crisis, of $5 trillion. This is what the central bank swap lines were designed to essentially back, is private sector money creation that's not only, I mean, it's not only private, it is completely outside the regulatory purview of U.S. monetary and banking authorities. And we've decided this is another indication of the degree to which we've just allowed money creation to be privatized. Someone referred to Milton Friedman's article, Eurodollar article, was it Roy, yesterday, and made this very point. So I just view that as an abrogation of monetary sovereignty. This is getting away a little bit from your question. That's the only line in there that is not that is me guessing based on some Bank for International Settlements data. The rest of it's easily gettable.
Can I follow up on your? So you ask what's the right way to calculate the money supply. I think it depends on the question you're asking. So are you asking a question about money as something that creates a risk of inflation, or money as some kind of short-term financial claim that creates a risk of financial stability? So a very interesting kind of, irony here. The Fed used to keep track of something called M3. So M3 was a broad measure of money that included, among other things, deposits and money market funds. At some point, they abandoned it because they decided, like most quantity measures, it was pretty useless in forecasting inflation. However, if you kind of had this different perspective, M3 jumped a lot in the years leading up to the financial crisis because it was capturing all this shadow banking activity. So it was very interesting, with the benefit of hindsight, as a financial stability thing, because it was picking up all this sort of shadow banking and nothing to do with inflation. So this comes really to what do you care about in this whole money thing? I think if you care about inflation, it's good to just think about kind of the interest rate. The quantity stuff is not interesting. If you care about financial stability, the quantity stuff is very interesting, and you care about exactly who's doing the creating of the money, rather than the aggregate quantity.
So thanks for a great panel. So I have 2 questions for all 3 panelists. One question is about the distributive implications of narrow banking. And here, it goes back to an issue that came up in a panel yesterday about whether we think of ourselves as consumers or producers or citizens, et cetera. Let's think of ourselves as borrowers for a moment, as opposed to depositors, right? So when we talk about ill treatment by banks because we get a lower rate on deposits, we're implicitly assuming that the entire rate spread is actually going to the banking sector, and that implicit assumption seems to further assume that there is basically no competition whatsoever within the banking sector. So if we introduced even a moderate degree of competition, we might think of part of the interest rate spread as being passed on to borrowers, and that raises interesting questions about the profile of bank borrowers as opposed to the economic profile of bank depositors. So that's the first question. The second question, I'll be quicker, and that's about monetary transmission. So my old boss at the Fed used to say that there are problems, there are dam problems, and then there's monetary transmission. So not to dive into the full complexities of the transmission mechanism, but usually when I think of the transmission process, I think of it as something that is happening on the liability side of most economic actors, and especially of especially of banks and dealers. So the Fed controls transmission by controlling their cost of borrowing. And this talk about narrow banking seems to me to envision a different kind of transmission mechanism, where it is the rate that depositors are getting on their banks. It's something that is happening on the asset side that is controlling something like their marginal propensity to consume, or so that is an interesting channel, but it seems to be very different from the way that transmission has worked for decades now. So the second question is whether this is envisioned as a paradigm shift in the way that monetary policy transmits. Thank you.
I'll take a stab at those, and thanks very much for both questions. First question is very interesting, and if I may say, is really answered in that paper with Antoine Martin and David Ski, International Journal of Central Banking 2017, that I wrote. The point is that there's a spread, and you're saying, does the bank give some of that spread to the borrowers from the bank? The spread between what the bank can earn at the interest at the Federal Reserve and what they pay depositors. But I'm afraid that they don't give any of that to the borrowers from the bank, because the bank, I'm a bank, and I can deposit at the Fed and receive the interest on reserves, 2.2%. And you come to me and say, hey, why don't you lend to me at 1.5%? It's completely risk-free. Why don't you lend to me at 1.5%? You're only paying your depositors 10 basis points. And the bank says, no, I won't lend to you at 1.5%. I can lend to the Fed at 2.2%. Thank you very much. Go somewhere else. So all of that spread is captured by the banks. It does not go to the borrowers. The hurdle rate, what the Fed is doing, and that gets kind of to your second question, what the Fed is doing is setting the hurdle rate for safe lending throughout society by setting that rate. And indeed, that is a hurdle rate. Now, the fact that depositors get paid much less is a distributive issue. And I have not worked on this as a different way of monetary transmission. But the point is, it would put more money in people's pockets rather than in banks' coffers. So that's the way I see it, which I think would be wholly positive for distributive justice and democracy in the United States.
I'll just add to that. I mean, the banks, in theory, should be pricing their loans based on their marginal cost of funds, and that's the Fed funds rate, which doesn't need to change under a narrow banking or under reserves for all. So there's a lot of economic evidence. When the Fed raises interest rates, banks immediately raise their prime rate, and then the deposit rate kind of sluggishly comes along, right? And so I think that's a good indication that there's a disconnect between these two. But even if you wanted credit subsidies, let's suppose we wanted credit subsidies, right? We wanted this passed along. Is subsidizing banks a good way of doing that, as opposed to subsidizing specific classes of credit or groups of people that we wanted to? I think we can think of other ways of doing it.
Thanks. So one large question and a more sort of focused question. The large question is, Morgan, you mentioned the sort of rise of central bank digital currency literature in the recent few years, and I would just question how seriously we should be taking the idea that this sort of technological shift that started in these private sector Bitcoin and things, and now finally the public sector is saying, okay, we need to do something about this, is going to change things more broadly even than just these issues. It seems like, and I'm looking forward to Mercer's talk later, that there's a sort of stakeholder interest in fixing wholesale markets or wholesale interests, retail interests, banking interests. But I would add a fourth one, which you started with your first talk with, Morgan, which is cash, and having a digital equivalent to cash, which has the ability for transactions to be made without some intermediary account holder, and dealing with the anonymity benefits of cash that you can't replicate simply by passing a law to protect the database of a central database, et cetera, and that we really should be thinking about all of these, I think, coordinatedly and thinking about the way that a change platform will push them all together. But the other question more narrowly, and this is sort of more to Jeremy's responses, with regards to saying that the Fed taking on sort of credit analysis is a sort of fiscal policy, I'd say we're already there. I mean, we have collateral frameworks already. The Fed is making decisions about what assets it's going to be purchasing that are private sector risky assets. These are risk decisions of value. These are decisions of qualitative judgment. And people like Harman Minsky, who advocated going to the discount window first, that wasn't because he was naive about the level of analysis that goes into these decisions. It's because he recognized that liquidity scarcity as a form of discipline is a failed regulatory regime. And if we need to lean into this kind of credit analysis, you're right, it's going to be a big, hard, scary thing. But the Fed's balance sheet's going to expand next time there's a crisis anyway. So we might as well own that fact rather than keep pretending, I would say.
I'm not going to pretend to follow everything you guys are talking about, but my question is also kind of about the monetary policy transmission mechanism. Like, how do you guys imagine, the Fed, holding all of the deposit liabilities or issuing all the deposit liabilities affecting the transmission mechanism of monetary policy and maybe the volume of debt in the private financial sector? Yeah, so that's it.
In principle, there's no difference, right? You can, if you want to raise rates, you either raise administered rates or you shrink the size of your balance sheet. And that's true whether only banks can own reserves or whether you open it up more broadly. So I think the only change in the transmission mechanism is you no longer need pass-through, right, as the thing that you need. If everyone has access to central bank money, then that problem just disappears.
So I guess, so how would it affect financial stability if you still have the same volume of debt in the private financial sector? Like, how would that help?
So this gets into a big question about what kind of financial instability we care about. My own view, and Ben Bernanke has this wonderful recent paper where he says, actually the financial crisis proper, the systemic run on the system on private monies was the proximate cause, was what made the Great Recession great. And Bob and I have had an ongoing debate about whether that's right or not. There's a differing point of view. But if you agree with that, then crowding out private monies is the most, or getting rid of, whether it's crowding out or whether it's regulatorily suppressing them, is maybe the single most important thing you can do for financial stability. So I think it'd be very, from my perspective, enhance stability.
Do one last question. So I guess I want to question the whole premise of this. So I want to question the whole premise of this. So, one of the things you've said is flighty depositors should be offered safe facilities in the first place. And I think there's a question whether the actual problem with our financial system isn't precisely that we're giving safety to financial contracts and especially big financial intermediaries. There's this whole problem of the sudden growth of demand for safe assets, right? Everybody wants safe assets today. Well, didn't we create those through changing the underlying system of collateralization by changing the laws governing collateralized contracts through the 90s and whatnot? Through derivatives, the law governing derivatives collateral, and all of those changes, like suddenly we are giving this structure to have too many, this safety, so now everybody is looking for safety, and the whole repo run in 2008, perhaps that was driven by trying to create safe assets for these entities when the financial system works better with them actually figuring out how to manage risk.
I have a lot of thoughts on that. Maybe I'll let Jeremy do it. I would just say one thing. The QFC rules in bankruptcy, that's something that's been written a lot about. Eurodollars were run on too, and they're unsecured. So this isn't just about bankruptcy rules or security interests.
So it's a great question, and I don't have an answer, but I'm just going to give an example of why it's a great question. Most of the work that all of us do, it's exactly as you say. We take as given that there's sort of this demand, and that it's in some sense a wholesome demand that the social planner should want to accommodate, and then we're thinking about designing rules to make it as undamaging as possible. But if you think about actually where did a lot of this demand come from in the run-up to the crisis, there was this very big growth in institutional money market funds. That itself was the mirror of an enormous growth in corporate cash holdings. Okay? The corporate cash holdings themselves reflected a lot of big companies that didn't want to repatriate basically because of some tax stuff. So they were keeping a lot of their money in money market funds. You could have imagined either with a different tax law or with a slightly different agency configuration inside these firms, they wouldn't have decided not only to hold this huge amount, but it had to be in a dead safe asset. Why does Apple have to have, you know, they could hire a few more guys in the treasury function, you could imagine, and then they could hold a slightly riskier set of assets. We never question any of that. I don't know where that questioning would lead in terms of the, but fantastic thing that is, I think, always kind of pushed off to the side in these discussions.
So I hope you join me in thanking the panel.